Now, tonight we're going to be discussing RSI, Relative Strength Index. Now, I've met a lot of traders that have been trading for a long time, and they just know RSI. And I say to them, Relative Strength Index, and they don't even know what I'm talking about. Well, that's what RSI is. Relative Strength Index is the name of the indicator. Now, RSI falls in the category of a momentum indicator. And it was developed by a technical analyst named Wells Wilder. And it was published in 1978. Now let's start thinking about 1978. Well, I started trading in 72. Yeah, so now you know how old I am. But in 1978, we barely had computers. We didn't have individual computers. Those were the days we had those great big glass offices that had to be air conditioned, kept ice cold, and we had a couple MS-DOS green, not MS-DOS, we had these green screens. And there was really nothing we could do. It basically collected information, collated information. But there was no Windows, there was no internet, there was no PCs. And to be honest with you, the markets took a long time to catch up. I remember sitting in the pits reading ticker tapes, hand charting. So when RSI was released, it was developed for a slower moving market. And what was really traded in 1978? Predominantly stocks. There was some trading and some speculation on the Commodities Board of Exchange in Chicago, but very little. Now that's where I trade. I trade agriculturals way back when. But the world was a different place. We'd sit in the pits and watch the ticker tape and hand chart everything. We were lucky when faxes came along, we could get updated fax information for what was going on around the markets. There was no financial news television. Again, there was no internet. So everything moved a lot slower. But as the markets developed, as online trading developed, we found that by taking Wells Wilder's RSI and dropping it into a fast-moving market, it worked extremely well. And RSI today is one of the most popular indicators for trading Forex and CFDs, and especially for online traders. Now, RSI is always, I can't say 100% of the time, but most time is located at the bottom of your platform underneath your price charts. Now, you can, of course, today's computerized charts allow you to do anything you want to do. You could put them at the top or the middle. Okay, but they are normally found at the bottom of your price chart. Now, RSI falls into a category called oscillators. Why are these called oscillators? Well, think of an old radio oscillator. It's something that just goes up and down, up and down, up and down, but stays within a boundary. And these are actually, RSI falls into what's called bounded oscillators. Because number one, it looks like a radio wave going up and down, and is bounded always between 0 and 100. No matter what the market does, no matter what asset you're looking at, no matter how you do the calculation, it will always come out between the numbers of 0 and 100. It won't come out a negative number, and it won't come out 842. Because the way the formula is developed, it will always come out between those values. So this is a live chart. This is my teaching chart, so I haven't selected for any other reason besides teaching. Now, on the bottom here, we've placed RSI by simply clicking on the indicator section and selecting our relative strength index. Now, RSI will always be put on your charts on a standard 14-day or 14-period pattern. It will always, no matter what happens, calculate between 0 and 100. Now, it has also barriers. Okay. The standard definition of the barrier is a 30 and a 70. So in other words, when the indicator, which we're going to calculate shortly, falls below the 30 level, it is said that the market is oversold. When it breaks above the 70 level, it is said that the market is overbought. Now, there are two important things to know about this indicator. First, you have to understand the words overbought and oversold. Overbought doesn't mean the asset's going to reverse. Overbought doesn't mean it's going to go into a downtrend, doesn't mean that the current trend is actually over. Oversold doesn't mean that you should jump in the market and buy that the asset's going to reverse. An oversold market can stay oversold a very long time. An overbought market can stay overbought for a very long time. And the indicator tends to, once it comes overbought or oversold, go back into its normal barrier under the 70. So please do not set yourself up for huge losses by simply saying overbought means I should sell or I should get out of the market. There's more things to the indicator than general assumptions. And there's many other ways to use this indicator. So it's not very complicated, but you have to understand how to use it properly. So let's talk a little bit about what this indicator will do. Now, I'm a firm believer in that in order to use any indicator, oscillator, anything you can put on your charts, you must understand where it comes from. Now, I happen to be a mathematician, an old one, not so good one anymore, but I happen to be a mathematician. So I understand the numbers and how to crunch the numbers, but you don't need to. First of all, RSI is automatically calculated for you. But in order to understand when the asset is when the indicator is working well or not, you need to know where these numbers are being generated by, okay, and what affects the numbers. So RSI is a very, very simple calculation. RSI is equal to 100 minus 100 divided by 1 plus RS. Now, RS is the average number of days or time frames when the instrument closed up or down. Okay. Sounds really easy, doesn't it? So let's simplify this. What we do to calculate this, and like I said, you never have to calculate it, but you do have to understand it. What we would do is the normal look back period for RSI is 14 periods of 14 days. If you're using a 1 hour calendar, of course, it's 14 hours. If you're using a 1 day chart, it's 14 days. So it's 14 periods. Now, what you would do with RSI is to calculate is you would go back over the 14 periods and you would take all of the periods that had gains, that closed higher than it opened, and take the sum of those gains for each of those periods and divide it by 14. You'd also take all of the periods that it lost and divide that by 14. Now, if you know simple math, we know if we multiply 1 times 0, or we multiply 50 times 0, it's always going to be 0. If we take 0 and divide it by 14, it's always going to be 0. So whenever you didn't have any gains or losses in that period, so in other words, if every period closed higher, so you had all gains, you would have all the gains and divided by 14. But then when you took all the losses, which would have been 0 and divided by 14, you'd have 0. And guess what we're going to do next? We're going to take the average gains times 13 plus the current gain, which is how you find the average, and the average losses for 13 plus the most current one and divide it by 14. Now, taking the prior value plus the current value is a smoothing technique. So Wilder's formula normalizes RS and turns it into an oscillator that fluctuates between 0 and 100. So since we're going to take the gains and the losses and multiply them by each other, and if one of them is 0, what will be the outcome of your indicator? It's always going to be 0. So RSI is 0 when the average gains equal 0. Assuming that the 14 period, the 0 RSI value means price moved lower for all of those 14 periods. There were no gains to measure. RSI is 100 when the average loss equals 0. This means price moved higher all 14 periods. So no matter what happens, the number will come out between 0 and 100. But it's important to remember we have overbought and oversold, but we also have this oscillator moving between these numbers. Now, this oscillator will oscillate and have more volatility, say for Amazon, which is an active stock and fast moving and all around, than say Duke Energy, which is a much slower moving asset. So Duke Energy may hardly ever move enough to push it over the 70 or under the 30, where Amazon might always be pushing up into the 70, 75, and 80, or falling down to 20 and 25. So you can adjust these barriers. Like I said, the 70, 30. If you see an asset, see its personality is to be up in the 80s and 90s in the calculation, well, you might want to move your barrier, because that's not a calculation, that's still a wall, a fence. So how would we do that? Okay, so it's pretty easy. So we're looking down below here, and whatever charting service you're using, or you're using the charts on X Central or with your MT4, they're going to give you a settings button. When we click on settings, okay, we can first set this up. We're using 14 length. That's the standard default, and we're using a close. Unfortunately, today with computerized charts and computer developers who develop too much stuff because they don't actually trade, they're just computer people. Here you can set it to use the open, the high, the low, the close, the high, the low divided by 2, a whole bunch of hogwash. And then what eventually happens is you find some guru out there trying to teach a system or sell a system that he's come up with. RSI works great if you use the 14 plus the OHLC, the open, the high, the low, and close divided by 4. Or you use an EMA of the price. None of this really works that well. This is just computer guys giving you lots of choices. Stay with the close. Because you know what? On the whole, this is how the oscillator was developed. This is how it's been checked and rechecked. And this is how everything you read is based on 14-day or 14 period and close. You can adjust the length of the time period, which again, depending on the personality of the asset. You can also adjust the style. Okay. Now we always have a 50 band at the middle. Let's make that so you can see it really easy. Because this 50 isn't a calculation. The 50 line is simply halfway between the 100 and the 0. And we use that to see shift changes. When the price or the indicator starts moving above 50, it's telling you that we had a shift in the overall, not trend, but the overall attitude of the trend. When it falls below 50, it tells us something different. So it's only an information line. Now, we also have these barriers that I told you were at 70 and 30. The standard setting from Wells Wilder is 70 and 30. A lot of people use 75 and 25, which is another standard choice. But this isn't changing any calculation. It's simply changing the barrier, the no man zone, this purple area. And this purple area, you can change whatever color you want also. But depending on your asset, so a lot of people say this particular asset is only oversold when it's over 75. Say, for instance, Bitcoin, which moves a great deal, okay, which is very, very strange. But as much as Bitcoin moves and its overall volatility, look at that. We can look at it, and Bitcoin on the whole stays between the 70 and the 30. So we wouldn't need to adjust it. Okay, because looking at it historically, we would see what range it gave us very good signals in. Here, when we're looking at the British pound, look at that. It never even builds any momentum. So here we would stay with the 70-30. Again, it's not changing anything you do. It's changing only what you would interpret as the overbought and oversold. Okay? And you can always change your mind. The only reasons to set the barriers is to make it easier to see. The euro US dollar happens to be an asset that moves a great deal. Not a big difference, but it's moving, it's volatile all day. So in here, I've moved mine to 75-25. Because you don't want to always have an asset that's over pushed into oversold or overbought, because then it's not really telling you something. So if you know that this asset tends to stay towards the higher numbers, change your boundary, because it's not a calculation, it's just a visual boundary. Now, in each one of these charts I've clicked through, you can see different interpretations of using RSI in combination with other things. RSI here combined with MACD, combined with a chart pattern, gives us a very nice little trading system. And here we're saying here, right here, RSI was back over 40, but stayed below 30, and it stayed below the 50 line, whereas MACD was doing a bullish crossover, and we had a developed triangle with a price break from the triangle right at resistance. So that is part of a trading system you might want to develop. Here, we've used something called, what's the name of it now? It's a new system using ovals. And you can see these ovals between prices and the oval movement in the indicator. Again, here, we've combined it with stochastics and support and resistance and a chart pattern to use this. Now, remember, the word indicator means indicate. There are some people who make whole trading systems out of indicators. To me, an indicator only indicates. An indicator is an interpreter. If you can't figure out what price is trying to tell you, then an indicator might interpret it, help interpret it for you. I firmly believe that no indicator should be the first part, or a group of indicators should make up a trading system. Ultimately, it's price, and it's price and what price is doing. And by simply looking at indicators, you don't really see what price is doing. And indicators don't always, excuse me 1 second, please. Hello. Can you bring it up? I can't come down. I'm teaching a class. Hello? Okay. Are you here? Okay. Give me 5 minutes now. Or else come up. Then you have to come upstairs. Okay, the door code is 3456 and then the star. I'm sorry? 3rd floor. Okay, good. Call me when you're here. Inside. Yes, thank you. Sorry about that, guys. Okay, so we have to remember that RSI is just an indicator, okay? And it helps you interpret what the market is telling you. And in order to use an indicator properly, you would build some type of a trading system or strategy, and then, and only then, if you couldn't figure out what you're seeing on the price chart, is then use it with your trading system to get clues, to interpret what the price is trying to tell you. And there's many ways you can use RSI. You can use it for divergence. You can use it with multiple trading systems. You can use it with support and resistance, but it's for you to incorporate it into your trading strategy. And once you understand what it's doing and what it's telling you, it's very important because it is a momentum oscillator. It doesn't give you transaction signals. It doesn't give you buy and sell alerts. It tells you what the momentum is of the price in the direction that the price is moving. So thank you very much for joining us tonight, and we'll talk to you again real soon. Bye now.